Disruptive stocks have arguably been the biggest force for change in equities markets around the world. I mean, you just have to, in the past decade or 20 years, you just have to look at Google, you have to look at Facebook, Netflix, anything with an acronym beginning with FANG. You're talking about major changes and major increases in value for early investors. Now, in Australia, we've had, we've experienced that, and more directly, in recent times, we've had Afterpay, which, and to a lesser extent, Zipco. So these are buy now, pay later operators, and they've been huge forces for wealth appreciation on the ASX. And we were lucky enough to get into these sort of companies early on, and we sold out arguably too early. But basically, what we're doing is we've been looking for disruptive companies with that sort of potential, and I think we've done pretty well in finding 3 of them, which we've investigated in the past 3 issues. The first one was a medical technology stock called Volpara, and they do an AI-based sort of technology that looks to diagnose breast cancer. So this company's got global sales, and it's cracked the US market, but it's it's still early stage. Another stock is Hazer Group, which is an innovative company, uses biogas to produce hydrogen and also graphite. So this is a company that has very low cost of production and is clearly a company for whose services are going to be in great demand in places like Japan. Lastly, there's a company that's run by David Kirk, and this is a company that invests called Bailador Investment Technology. They're like a venture capital group that invest in software as a service and in data-based B2B businesses which are pre-IPO. So this is a type of investment that provides retail investors with something that otherwise wouldn't be available. I mean, interest rates matter because they're the price of that's the price of money. So what this does is it just shines a spotlight, these low interest rates verging on zero, it shines a spotlight on how valuable a 5% ongoing dividend yield is. I mean, you really need income when you're looking at investing. I mean, whether it's short term or long term. And what I guess we're looking at are companies that can produce ongoing dividend yields of 5% versus like a bond, a government bond which is paying 2%, from which, at 2% there's price risk. So if interest rates go up, the value of your bond actually goes down. So I guess it just highlights the importance of dividends, and that's what we're focusing on in the next 2 issues. Well, what they can expect to see is what we look for when we're picking small cap dividend stocks. So what our criteria is. So you're looking for a strong balance sheet, strong operational cash flow, and the types of companies that we've put in our dividend portfolios in the past, and we're looking at how those portfolios have performed. So I'm pleased to report they've produced extremely strong cash returns and actually capital returns. So we're going through that, and we're also beyond that going to be looking at dividend stocks that are worth investing in now. I mean, one such stock could be like Gale Pacific. Now that's a shade cloth manufacturer that's had a number of false starts in terms of growth. But what you're looking at is if you're looking for $300 of income a year, well, you can spend $3,000 and get 10,000 shares in Gale Pacific, and the strength of the balance sheet and the operational cash flow basically means there's a high probability of them paying out 1 cent of dividends each half. So you've got that kind of almost certainty of income, 6% dividend yield, plus you've got great capital growth potential. Well, there's always risks in any investment, but I mean, as I said before, you're looking at a dividend yield of 6% versus a government bond yield of 2%. So straight off the bat, you're operating off a higher margin. There's that factor in terms of the payoff for those risks. The other thing is when you're investing for dividends, you're basically saying, I want the dividends, and the share price movement isn't as important. And so you're investing for the long term. Like, that's what dividends give you, that long-term certainty. On top of that, we recognise that things change. Like, situations change per company. Every company is like a moving feast. So we're on top of that. So any company that we recommend, we cover very closely. And when those situations and circumstances change, we alert subscribers. So let Under the Radar take that sort of worry away from you and just bank those dividend payments.